So if you bought Apple stock at 10 and now it's at 160, so it's up $150 a share. When you donate that Apple stock, you not only get the charitable deduction for the $160 it's worth today, not what you paid for it years ago, but also you'll never have to pay those capital gains taxes.
Adam, what is the number one secret to using a donor advised fund to your tax advantage?
Believe it or not, the number one secret is just to know that there is such a thing as a donor advised fund. Donor advised funds have been around for decades, and yet most people have never heard of them. If you don't have a professional financial advisor or a high-end accountant, most likely you've never heard of this type of account, but it's not that complicated. We're used to having individual retirement accounts and 401ks for retirement savings, or 529s for college savings. There's different accounts for everything. And the donor advised fund is just a great tax advantaged account for money and assets that you're putting aside for charity.
Excellent. So it sounds like the number one secret is just to actually be aware that it actually exists. So what's the number two secret to using a donor advised fund to your tax advantage?
Well, yeah, it's probably worth going into a little bit of what the donor advised fund is. So the idea behind the donor advised fund is they can only be offered by nonprofits themselves, right? DAF is a 501c3 registered not-for-profit organization. And by putting assets and money aside in this account, you get this immediate tax advantage because by putting money in the account, that counts as the charitable donation, right? So if you're like a lot of us, you have some good years, some not so good years. Of course, in our tax system, those good years are very, very expensive. Those are usually years that you want to put money aside for charity. But you don't necessarily want to give it away all at once, and you don't necessarily know who you're going to give that money to. Unfortunately, our tax system is very strict, right? It's from January 1st to December 31st. And so if you have big gains in a year, trying to rush and figure out where to give your money is a real problem. So the great thing about a donor advised fund is it just separates those two problems. The problem of how much you want to put aside for charity versus who you're going to give that money to. And so donor advised funds let you put money aside now, get the tax benefit now, and then you can spend time figuring out which organizations and causes are the best recipients of your money.
You can learn more about Adam Nash by going to daffy.org. That's daffy.org. So it sounds like the number two secret there is just the flexibility with timing, not only timing for the amount that you want to put in per year, but also the timing for who it's actually going to go towards, because you might be a entrepreneur, real estate investor, someone who's building massive wealth in the tech industry, cryptocurrency, whatever. And you're like, hey, I want to give, but I'm so focused on this. I don't know who it's going to be. I have these 365 days to do it in this year. I can open up a donor advised fund, but I don't have to decide who it's going to go to. I just know I'm going to be giving it to charity. Is that a fair summary so far, Adam?
Yeah, that's right. So number one, you want to know what a donor advised fund is and open one. And the second one is, in any good year where you're going to face significant gains, those are the years you want to be funding your donor advised fund.
Excellent. So what would you say the next secret is, or the thing that's most commonly overlooked when it comes to the donor advised fund and using it to your tax advantage?
Well, this is the big one. So number three is, whenever possible, you should be donating money with assets and not with cash, right? Appreciated assets. The charitable donation by itself is one of the most generous deductions in the entire tax code. But you get a double benefit when you donate assets because you win two ways. One is, of course, you get the full charitable deduction for the amount, the market value of what you donate. So if you bought Apple stock at 10 and now it's at 160, so it's up $150 a share. When you donate that Apple stock, you not only get the charitable deduction for the $160 it's worth today, not what you paid for it years ago, but also you'll never have to pay those capital gains taxes. It's one of the few cases where it's a real win for you in terms of your taxes, but also it's a huge win for charitable organizations because, of course, when they receive that $160, they don't have to pay taxes on it either. So it's a wonderful way to get money and capital to the causes and organizations that you support the most.
Absolutely love that. So make sure I caught that. So let's say you had $16 million of Apple stock that you've accumulated over the years through either purchasing it yourself or just as an employee of Apple stock, being rewarded that. And let's say that basis happened to be about $1 million, but now it's appreciated to, let's say, 16 million, right? So you have a $15 million gain. What you're saying is, hey, you have a chance to just, you could just donate all of those assets to a donor advised fund, and it's going to get a full basis, meaning you've eliminated that capital gains tax, right? Because it's now full basis with the donor. And then number two, I'm sure I caught that. You pay capital gains tax, but I don't guess what the other part was. I missed the second part, Adam.
The other part is when you contribute that stock, you get the charitable deduction off your taxes. And remember, the charitable deduction on your taxes does not come off capital gains. It comes off your income. And actually, it's a very generous deduction. Up to 30% of your adjusted gross income in any year can be deducted when you donate stock or crypto, anything with appreciation over 1 year, long-term capital gains. And so that's the double win, is you get the charitable deduction off your income taxes in the year you make the contribution, and you never have to pay the capital gains taxes on those assets.